It is 12 o'clock, and I guess we can start going. I don't know how many students we'll have for this particular lecture in 80007, Accounting 110, Chapter 5. But let me get started by sharing the screen, and we're going to take you through a pretty tough little chapter here. But I hope you find it a little bit interesting. So let me rack it up here. Hold on. Okay, let me see if I can share it. I pray that you see in front of you the worksheet. I wish there was one student here to let me know for sure that it's up there, but let's assume that and we'll go from there, okay? Make it a little bit bigger, okay? We are now going to talk about something you've not seen before called adjusting entries. Hi, Jonathan.
Hey, good afternoon. How you doing?
Good to hear from you, Jonathan. Can you see the PowerPoint?
Yeah.
Oh, good. You came in exactly at a good time here for Counting 110. Jonathan, you're going to be my audience today, it looks like, okay?
Okay.
So anyway, adjusting journal entries is what we're going to talk about. What you've learned so far, hopefully, is that you record transactions all month long and you enter them into your journal entries. You post the journal entries, which moves the data to the trial to the general ledger. And then you take those general ledger balances and you create a trial balance. The trial balance is the mechanism that lets you prepare your financial statements. And up till now, what we've done is take that trial balance and work with it directly. What we need to learn, though, is at the end of the month, the trial balance, by definition, is incomplete and incorrect, and it must be fixed with what are called adjusting journal entries. All companies make these entries. So let's try to learn something about them here, okay? This thing is making me look like an idiot. Hold on. Okay. Prepare end of the period adjustments. At the end of the month, certain things have happened that we can record. Equipment was wearing out. Big, expensive equipment, long-term assets, that equipment's wearing out. We're allowed to depreciate that. Prepaid insurance, prepaid supplies, prepaid rent, prepaid taxes are being used up. We need to write an entry to record the extent of that expense. Also, employees earning wages that have not been paid yet. Now, I'm assuming that you guys have been out in the workforce. You work the last week of a month, but you're not going to get paid till next month. But that week that you worked in the current month, that expense belongs in the current month. And that's going to be an accrual entry, another example of an adjusting journal entry. And again, let me point out that all companies have to make these adjusting journal entries. Since these events we just spoke about, the equipment wearing out, the using up of the insurance, and the wages that have not yet been paid, since these events have not been entered into the accounting system, adjusting entries are necessary. And the reason for the adjusting journal entry is the matching principle. The matching principle, maybe the most important of the many GAAP principles. Matching principle, revenue versus expenses. That's what we're matching, revenues and expenses. The revenue recognition principle, we should know this already. says that revenues should be recognized when earned, regardless of when cash is received from the customer. Revenues are considered earned when a service is provided or a product is sold, okay? The recognition of the revenue and the expense does not follow the cash. Expense recognition principle. Expenses should be recognized when incurred, regardless of when the cash is paid, and they're incurred when they've actually happened, when we've actually experienced the expense. And again, the matching principle, so important. You're matching revenues and expenses. To do so will provide us with the best measure of net income. So we need to follow these principles carefully. I think we know what a fiscal year is. It's an accounting year. It doesn't have to be a calendar year. Some companies close at the end of May, some close at the end of August. It's just up to each company. Some companies have a strategic date for when they close. A department store, for example, would probably want to close at the end of maybe January or February to scoop up all the sales and get out a year-end report for the most recent big months of sales. Adjustments are made and the financial statements are then prepared. So let's go through our adjusting journal entries. And these are a little tricky, Jonathan, until you do a few of them. We bought supplies. Remember, we bought those supplies for $80. That's an asset. Supplies are an asset. But according to the inventory at month end, we went out and we counted the supplies. There were only 20 dollars worth of supplies left at the end of June. That tells us that we used $60 of supplies. We no longer have 80, we used 60. So we're gonna have to write a journal entry. Our journal entry is we are going to debit supplies expense and credit the asset accounts. If we don't do that, our assets are going to be overstated and our supplies expense would be understated. The financial records would be wrong. So let's take a look at the entry here. Here are the supplies, the original supplies, 80. We credit that because we counted 20. We know we used 60. We debit the expense, credit the supplies. So if you're doing these problems, you guys, and you're working with prepaid supplies, don't think what the expense is. If it's prepaid supplies, the expense is going to be supplies expense. If it's prepaid insurance, the expense is going to be insurance expense. Okay? You're turning that asset, prepaid insurance, say, into insurance expense. And take a look at the journal entry. You debit $60 to supplies and credit. You debit $60 to supplies expense, credit 62 supplies. So that's one of the prepaids. Let's look at another prepaid insurance. Here, they bought a policy for $700 with the coverage beginning on June 1st, and the policy expires over a period of time. So let's see what they're talking about. Now that June is over, we need to remove the cost of 1 month's insurance. It was a 7-month policy. $700 divided by 10 is $70 a month. So we're going to have to debit insurance expense for $70 and credit prepaid insurance. See how the word insurance follows into both the debit and the credit? And let's take a peek at it. Here is our insurance expense. We debit and we credit prepaid insurance. Not too bad so far, Jonathan?
No, that seems right.
Pretty basic so far.
Mhm.
All right, we'll keep going and let's see what else we got here. Now, Jonathan, you've been in the workforce, I'm going to assume. Is that correct?
Right.
So when you leave your building on Friday, your store, or wherever you work, you're not going to get paid that day for that day's work. You're going to get paid maybe in a week or 2 weeks, correct?
Right.
So here's what we're talking about, guys. At the end of the month, you worked $650 worth of activity. You worked 40 hours and you made about $15 an hour or whatever, and you earned $1,650. Since that money was earned in the month of June, it must be recorded as an expense in June, even though your company's not even going to look at your time card until a week or two. So this additional wage expense got to be reflected in the accounts. Wages have been earned but not paid. Rohan owes the employees for the additional wages. So you have to record an expense and a liability. You debit wages expense or wages and salaries expense or something like that, and you credit wages payable. That is a legitimate liability in every way. The company does owe you the money on that date. If they fired you that day, they have to pay you. If you quit that day, they have to come up with the money pretty darn fast. So it's a legitimate liability, okay? Unpaid wages. So let's take a peek here. Wages expense. Remember, they told us they had 1,650 earlier. That is simply the amount of payroll they've already paid and recorded. We just have to get that last bit of the month on that, $400 on there. So we debit wages expense and we credit wages payable. And here is our journal entry. So you can see there's a lot of activity that occurs between the end of the month and the period where we issue the financial statements. Most companies have a 2, 3, maybe even a day or two longer period to do all this kind of stuff and catch up on the financials. Now we're going to get into fixed assets, depreciation, which is another one of our adjusting journal entries. The historical cost principle. All these principles are important. The historical cost principle. Assets are recorded at their actual cost. That cost remains on the books as long as the business owns the asset. No adjustments are ever made for changes in the market value of the asset. You can never record a gain on the implied increase of an asset. For example, you bought property in Santa Barbara on the beach 100 years ago, your great-grandfather did, and you still own that land today, which is now worth tens of millions of dollars. You're still carrying it at the $10,000 that your great-grandfather paid for it. So what we need to do, though, is recognize the wear and tear of the asset. And all assets are said to have what's called a useful life. The useful life expires as a result of wear and tear, or if the machine no longer satisfies the needs of the business. All right. So we can assign what we believe to be a correct and honest, useful life to a fixed asset. For example, you buy an expensive fleet of computers. Well, the technology changes so fast, maybe we'll depreciate those computers for 3 years. You buy a car for your company salesman to drive around the area. Well, that car is going to probably give us at least 120,000 miles. We can depreciate it for 5 years. You have to come up with what you believe to be the proper useful or depreciable life, and it must be reasonable. The accounting term for it is systematic and rational. You must have an honest life. You can't pretend the car is going to depreciate in 1 year so that you can scoop up a giant tax deduction, which is depreciation expense. So the expense of a fixed asset is going to be recognized over the life of the asset, over the useful life. And that expense is called depreciation. It's a method of matching the asset's original cost against the revenues produced over its life. Very simply, we're going to take the life of the asset, which is, say, 5 years, and we paid $200,000 for the asset. We divide 200 divided by 5 years, that's $40,000 a year. That would be our journal entry amount. Keep in mind that depreciation is really an estimate. It is an estimate and a way to allocate the expense of the asset over the period of time you think it's going to be useful for you. Okay. And yeah, our financial statements always have some estimated numbers in them. They must be reasonable estimates. Let's talk about salvage value. We depreciate an asset, and at the end of the year, at the end of the 5 years or 10 years or 20 years, whatever, we think that asset will still have a little bit of value. That value is called salvage value or residual value or scrap value. What it means is we've got that car that we bought that car 20 years ago, and our salesman, he's been driving the heck out of it. He loves the car. He kept it up, but now it's on its last legs, and the car is no longer able to pass the smog test. So we're in a position where we need to get rid of it. It doesn't have much value, except, a junk dealer would probably be glad to take it off our hands. Well, that scrap value, he might pay us, say, $500 for it. That scrap value is an amount we have to have in the back of our mind because we're not going to depreciate the scrap value. In a long-winded way, what I'm trying to say is you buy an asset for $100,000, the scrap value is $10,000, you only depreciate the $90,000. And we're going to be working with straight line depreciation, which simply means you take the original cost of the asset, divide it by the number of years, and that's your expense. There are many different depreciation methods companies can choose, and we cover quite a few of them in 230. 110, we're pretty much going to stick with straight line, which is an easy method and probably the most popular and defensible one. Okay, so in this example here, there's no salvage value, so we don't have to worry about that. So the 4,800 cost is going to be spread over 5 years, or 60 months, if you want to talk months. So here we go. We bought an asset for 4,800. It has a 5-year life, which is 60 months. Here is our monthly expense. Now, this journal entry should be the one you pray they put on the test. I say it's the easier one because it's always the same. It's always a debit to depreciation expense and a credit to accumulated depreciation. Book value is simply the original cost of the plant asset minus accumulated depreciation, which is another account in your chart of accounts. Now we're going to talk about that. The accumulated depreciation, you can call it the undepreciated cost. And keep in mind, as you're depreciating these assets, everybody, the value you're carrying on your financial statements may not, or I would even say most likely do not, have any bearing in terms of market value. The market value could be a lot different than what you're carrying at on your financials. So the book value, best called net book value, is the original cost minus what's called accumulated depreciation. Now, I told you this chapter is a little bit tricky. We're getting some new things here. But once you do a few of these entries in your homework and your practice quizzes, you really should be fine, I think. Accumulated depreciation is what's called a contra asset account. Good gosh. Contra meaning opposite, from the Spanish word meaning contra. It is an asset that carries a normal credit balance. Assets, as you should know very well now, have a debit balance. Accumulated depreciation is an asset, but it has a credit balance. It is an outlier. Whenever you hear the word contra account, you know that it's going to be married to somebody. And in this case, accumulated depreciation is married to the original cost of the asset. because we're going to take the original cost of the asset, $4,800, minus the 80, and that's going to give us a net book value of 4782 or something like that. So let's take a look at it. Let's talk about it a bit, okay? You have delivery equipment that you paid $4,800 to bring into your factory. We are never going to touch that 4,800. That's going to remain there forever, unless you sold the asset, which we're not going to do. So we have an asset of 4,800. We have to recognize that this asset is worth less and less each month due to normal wear and tear. We're estimating that amount at $80 a month. So we're going to debit depreciation expense. We're going to debit depreciation expense and credit accumulated depreciation. So on your balance sheet, you're going to see a line that says asset truck or whatever it was, truck 4,800. Then below, the next line is going to say less, less accumulated depreciation. Book value in this case would be 47. Would that be 4720? Here, they're just showing you some of the accounts. Some of them are new. You're seeing for the first time in this chapter, okay? Supplies expense, we haven't talked about that yet. Insurance expense, depreciation expense. In other words, those red items there are the ones that will definitely require an adjusting journal entry. Accumulated depreciation, wages payable. Really should say accrued wages payable, but that's okay. Let me point something else out. I know we talked about this a little bit. Assets typically begin with a 1, liabilities with a 2, equity with a 3, revenues 4, expenses 5. That's all I ever saw in my working world, and it's pretty normal. Notice what they do though for the contra account. They add a decimal there, huh? They're saying that 185 is delivery equipment, but 185.1 is its marriage partner, the accumulated depreciation. So you're always going to net those two together. Let's post the journal entries. Post. Well, here we go. This we should understand pretty well how to post it. We write our journal entry, we hit the post button, and look what's happened here. Our general ledger, and this is the general ledger. Our general ledger, we had an entry, $60. We debited $60. That means that the balance after that was $60 because there was no beginning balance. There's never a beginning balance on expenses and revenues. Can you read these numbers, Jonathan?
Yeah, I can.
Okay, you may have to read them to me then. Okay. Okay. Let's just look at it real quick. And I know you know how to do this, but let's review it for everybody. We have a general journal, a journal entry. We debit 60. Look how that 60 comes over to your general ledger. And that's the new balance. Same thing with the supplies, which is the asset. The supplies come over to the supplies account, which had a balance of 80. We credit 60, and you now have a balance of $20. Same thing with the insurance expense. The insurance expense, the beginning by definition is 0. So you have one transaction for 70, the balance is 70. And here you had prepaid insurance, the asset, we're crediting that to reduce it. So now we have $700 minus 70 equals 630. And we're going to write these entries, Jonathan, every month until we get a net book value of 0, assuming no salvage value, okay? Let's look at the wages expense. Wage expense. Well, they had a beginning balance because they had already paid for the first 25 days of the month. It was that last 3 or 4 days. So we debit wage expense. We started with a balance of 1650. It's now up to 2050, and we credit wages payable. And same thing with depreciation. We debit depreciation expense, credit accumulated depreciation. Remember, on your depreciation entries, it's always the same. It's always a debit to depreciation expense and a credit to accumulated depreciation. The tricky part is figuring out what the depreciable number is each month. So now we've done all this activity. Now we're going to prepare a big worksheet. Oh, ready? A worksheet. And it's going to pull together all this information. And we're going to use the worksheet to enter the adjusting entries and come up with the financial statements. And this worksheet is just a piece of scrap paper. It's typically going to be an Excel spreadsheet. It's not a formal part of accounting. It's only for the accounting nerds to use, okay? Typically 10 columns long. So let's take a look at it. Let's divide and conquer. We have 5 steps, okay? 5 steps. 1, prepare the trial balance. This is the trial balance before any adjustments. So your first 2 columns are debit and credit, whatever the trial balance yields at the end of the month. Columns 3 and 4 are where you're going to put the adjusting entries. So we're going to then take columns 1 and 2, the trial balance, add or subtract adjustments as necessary, and we're going to come up with what we like to call the adjusted trial balance, the final trial balance, the blessed trial balance. And we're going to use that final trial balance to prepare the income statement in columns 7 and 8 and the balance sheet in columns 9 and 10. Sounds complicated, but there's a certain logic to it that brings you across the finish line, I believe, okay? So they're talking about putting a heading on this thing. I wouldn't worry about that. I'm not gonna bust you guys on underlining and things like that. Okay. Let's take a peek. Here it is, Jonathan. Here's your 10 columns worksheet, okay? We ended the month and we had these numbers in yellow. This is our, let's call this what it is, the preliminary trial balance, the unadjusted trial balance. But remember, we wrote some entries. Remember the supplies expense? Remember we had 80 and it was down to 20? We debit supplies expense for 60 and we credit the prepaid supplies for 60. We did the same thing with the insurance expense. We debited 70 and we reduced this 700 by 70 with a credit. We had the wages expense you debit and you credit the wages payable. And finally, depreciation expense, and you credit, you can never credit the asset. What you credit is its married partner, the accumulated depreciation. And I'm going to give one tip because I see this mistake made a lot. You will never ever debit or credit cash in an adjusting journal entry. Cash can never be part of an adjusting journal entry. And the reason I mention that is students, I think, get a little rattled. Maybe they're under a little bit of time pressure on a test or they're rushing their homework and they are guessing a little bit. And sometimes cash is always the fallback. Well, it's got to be cash eventually. Okay. So not too bad with that so far, Jonathan, this worksheet.
Yeah, it seems doable.
Yeah, what we're going to do.
Confusing, but doable.
Yeah, divide and conquer. You have your beginning. Now, all we're going to do, Jonathan, is take these first 2 columns and add and subtract across to get to the adjusted balance. So let me take a look at that for everybody. Prepare the adjusted trial balance. Okay. Here we go. This is not hard. I don't want to say it's not hard, but the hard part is right here. The hard part are columns 3 and 4. getting the adjusting entry dollars in. That's the hard part, figuring out the journal entry. Once you have that, it's easier than falling off a chair, the rest of this thing. Start with cash. Never going to adjust cash or accounts receivable. So there's no activity. You just bring the balance over. It didn't change. You had $80 debit supplies, credit 60. You have a balance of 20. Prepaid insurance, 700. Credit 70. You're down to 630. You're never going to touch the equipment. That comes over. We had no balance in the accumulated depreciation. So that $80 credit becomes an $80 balance over here. Payables, you never adjust. Wages payable. You're not going to adjust capital, and you're not going to adjust drawings or revenues. And you have a few things to adjust here. You also have a couple of expenses that you don't need to adjust. Rent expense was recorded okay. So was phone expense. So look what we have here. We have a preliminary trial balance, debits equal credits. Our adjustments add up to 610, 610. And now the adjusted trial balance adds up correctly. Okay. So once you do a little bit of this, put one of these schedules together, hopefully it becomes second nature. Now we're ready to do the income statement and balance sheet. Like I said, we did the hard part in columns 2 and 3. 2 and 3. We're going to do the income statement. Wow, look at all these rules, which I'm not going to worry about, really, okay? Easier to, picture's worth 1,000 words and all that, right? Okay. Remember the Bob trick. Draw a line above your first revenue account. Here you just have one revenue account. Delivery phase. I'd put a nice dark horizontal line right across there, because everything above that line is balance sheet. Everything below that imaginary horizontal line is your income statement. So with that being said, all we have to do is go to the adjusted trial balance and take whatever's an income statement and bring it over here. We have a credit of 8,000, and then we have all these expenses with debits. And we add down 8,000 plus 0 is 8. We add these down. Good gosh, we're out of balance now. But we want to be at a balance on the income statement. We want to see a big fat credit number, a big sales number. So this company made a profit of 8,000 minus 3,360 in expenses. They made a profit of $4,640. We add that 4,640 to the total expenses, and we've now balanced these two columns. If we did things correctly, we should be out of balance by the same amount with the opposite sign control. And if you look here, they just brought over all the balances from the balance sheet. It was just copying. There was nothing more to it than copying. The income statement and the balance sheet, these 4 yellow columns, it's just a matter of copying from your adjusted trial balance, making sure each one is on the proper line. So we look here, we had a total of 12,020 minus 7380. Hey, we're off by the same amount, and that's good, because we're going to end up zeroing out these expenses and increasing capital with the credits. Okay. Any question, Jonathan, so far?
Not yet.
Okay. You're my audience, Jonathan. I'm bouncing these ideas off you. Maybe extra credit for being here, right?
Hope so.
Okay. Now they're talking about methods for finding errors. I'm not going to waste time with this. Don't make errors, okay? They're telling you just double check your additions, common sense things. I'm not going to worry about it. Journalizing, adjusting entries from the worksheet. Well, here's our worksheet. And like I said, columns 3 and 4 is the hard part. What happened to my? Well, this is annoying. Okay. We have to write the journal entry. What happened to my cursor? All right, I found the cursor. Look at your income statement. Here is the trial balance. Here are the adjustments. Don't forget, we have to write the journal entry, Jonathan, and everybody. I'm sorry. We have to write the journal entry. Putting it on the worksheet doesn't cut any ice. We remember we still have to write the journal entry to put it into the general ledger. And that is the end of this chapter, Jonathan, because we're not going anywhere near cash basis of accounting or modified cash. We're strictly accrual people at Santa Barbara City College, okay? Any questions, Jonathan? Anything overwhelming, or you feel like you can get along with this doing the homework later?
Yeah, it's kind of all coming together now, like from like the beginning chapter to now. So I think
Excellent. That's
it's
what we,
going
that's
great.
what we, yeah. You've been keeping up with the homework, I can tell, right?
Yeah.
Yeah. Yeah, you get through this chapter in pretty good shape. It'll be a big step in the right direction. If nothing else, it'll prepare you very well for 230 when you get there. In fact, you guys are ahead of my 230 class because my 230 class, most of them have not taken 110, Jonathan, and they have to fight their way through this in like 3 weeks. So they're battling right now. But
Yeah, I
okay,
was avoiding that position.
yeah. No, I think you'll be well served. I hope when you get to 230. All right, with that in mind, I guess we can call it a class. So, Jonathan.
Yeah, I think so.
All right. Well, I'm glad you popped in. Glad to have one visitor here. My act does not work too good without somebody to bounce ideas off. So I'm real glad you showed up, Jonathan.
Yeah, happy to be here.
Hey, you too. We'll see you on what's today? Wednesday. See you
Thursday.
Friday. Okay.
All right.
Hey, bye bye.
Bye.